And finally, some good news for baby boomers and those nearing retirement. The surging stock market has helped push 401k balances to all-time highs. So how long will this last? Joining me now, financial panel, Alan Haft, partner at Kelly Haft Financial, Greg Melia, president of the Melia Advisory Group and Advisories Academy board member, and Bankrate chief financial analyst Greg McBride. Welcome all. Greg, I'll start with you. So we've got new balance figures out from Fidelity. They say they're up 12.9% to $91,000 on average. How meaningful is this? And do you think it's changing the habits of consumers?
I actually think it's not changing the
I was
habits.
asking Greg McBride here. I'll get back to you.
Oh, sorry.
Greg McBride?
You've had both the stock and bond markets going up this year. So, you know, for a well-diversified investor, it's been pretty tough to lose money this year. You know, look, I think this is a good thing. People feel better when they see that 401k balance going up. It's just kind of one of those things that people kind of peg to gauge whether or not things are going in the right direction. The stock market, the other one is house prices. When those are moving up, people feel a lot better. So it's something that I think reaches beyond just how they feel about their retirement savings, but, you know, their overall financial security.
I think that's right, Greg Melia. I apologize. We have two Gregs on the panel tonight. I'll use your last name both times. But Greg Melia, to you, do you agree? I mean, look, you may think people feel richer, but they sure don't seem like it when you look at what they're spending.
That's what I see on the street. When I talk to people every day, their spending habits, the perceived wealth effect really isn't happening with the folks I talk to routinely. You know, in the late 90s, we had, you know, people were spending, the markets were going up, and people were actually feeling wealthier as a result of 401ks, and consequently were spending more money. Today, you really just don't see that, and that's why we see consumer spending as flat, and we're not seeing really any major increases there at all.
Alan, you say it's time to take action.
Rebalance.
Yeah.
You know, if you've been looking at your portfolio, it's probably been to both Greg's said that, you know, the balances have been going way up and people are feeling a little better about themselves. But you can't just sit idly and watching those portfolios. Now is a great time to rebalance the portfolios. If you don't understand what it is, look it up, because it's a super important concept. And don't be fearful of the sectors that have been underperforming, such as Europe. This is a good time, especially if you have a longer time horizon for investing, to load up on the sectors that are not doing so well, because today's losers are often tomorrow's winners.
Well, there's always a turnaround in that. Greg McBride, I want to change the conversation to interest rates. This is a conversation that's critically important to American families. We feel it every which way. Mortgage rates, we feel it in our savings. When do we expect some kind of turnaround in rates? You know, people have been forecasting it for years now, literally. What's your outlook?
Well, look, we've been in this ultra-low rate environment now for 6 years, Jerry, and counting. And, you know, every year it's kind of like the refrain of the Cubs fan, next year, next year, next year, right? That, you know, next year will be the year that rates go up. And look, maybe that pans out, maybe it doesn't. I think as far as consumers are concerned, you should be prepared for a rise in interest rates, whether that comes next year or not. You know, pay down variable rate debt, refinance into fixed rate obligations. You know, from an investor standpoint, insulate yourself from higher rates by, you know, tilting your bonds toward things like floating rate bonds and inflation index bonds. So be prepared for it, but again, I wouldn't pin all your hopes on the fact that rates are going to go up, because if the economy continues to languish, and at least in the eyes of the Fed, if inflation stays contained, they're not going to be inclined to raise interest rates.
I feel like I've got to give you a last name, too. It's just not fair. But tell me, what's your recommendation to your clients? So people who are asking you probably every single day, and maybe people who've gone out the risk curve when they've bought bonds. You know, lots of concerns now about high-yield bonds, junk bonds out there, people who jumped into that marketplace. What are you telling your clients?
Right. I mean, I generally tell people to stay away from long-term bonds. Anything longer than 7 years doesn't make a whole lot of sense to me. The reason for that is because on a long-term bond, say you're going to put your money into a corporate bond for 10 years, the best rates you're going to find right now on high-quality bonds is maybe, if you're lucky, about 4% taxable. For some people, it makes sense to introduce them into dividend-paying stocks. And I'm just using one example, like an AT&T paying 5%. If you're going to hold a bond for 10 years or hold AT&T and get 5% on an AT&T stock, there's a reasonably decent chance that AT&T 10 years from now should be worth at least a little bit more than it is today. So hopefully the purchasing power of your money is going to be a little bit higher than what you would get from the maturity date of a bond. So I'm generally telling people to stay away from long-term bonds, and also take a good look at bond mutual funds, of which there's no maturity date. So you'd be far better off, if you're going to be in bonds, to accept a little bit lower rate and get the maturity dates from shorter-term bonds, so you know you're getting your money back.
Well, Alan, that's a whole other segment, bond funds. We'll do it someday soon, and I'm sure we'll have you on for it. Alan, Greg, and Greg, thanks for coming on tonight, guys. Great to have you here.
Thanks for having us.
Thank you.
Thank you, Jerry.